You know, in the high-stakes world of startups and venture capital, something big is brewing. It's a new model that's really shaking things up, challenging how we even think about building and funding companies. So today, let's get into it. The rise of the venture studio. All right, let's kick things off with a number. If you rewind to just last year, you'd find that these venture studio funds, they made up about 6% of the emerging VC scene. You know, a decent chunk for sure, but maybe not something that would make you sit up and take notice. Not yet, anyway. Okay, but now fast forward to today. That number, it's shot up. I mean, it's more than doubled to 13%. And look, that's not just a little bump in the numbers. That's a statement. It's a huge signal that the folks writing the checks are starting to think very differently about how you build a company from the ground up. So yeah, a jump like that, it doesn't just happen, right? This is what we're calling the studio surge. It begs the question, what's really behind this dramatic growth? What even is a venture studio? And what's the secret sauce that's making them take off so quickly? And to really get it, you've got to kind of reset what you think about investing. We're talking about co-builders, not just backers. This is about redefining that whole founder-investor relationship. It's not just about cutting a check. It's about rolling up your sleeves and actually building the thing. So here's the official definition. A venture studio fund combines venture capital with company creation, actively building startups from the ground up. But what does that really mean? Well, think of it like this. A traditional VC fund, they're like a talent scout waiting for a superstar to walk in the door. A venture studio, on the other hand, they're the ones running the school, training the athletes, and building the team from scratch. They are both the architect and the construction crew. And this comparison really drives the point home, right? You've got two completely different models. On one side, the traditional VC. They're the financial backers, they invest in startups that already exist, and their focus is on managing a big portfolio. But on the other side, you've got the venture studio. They're operational partners. They build the companies internally with a super hands-on focus. It's like being a roommate versus just being the landlord. One of them just collects the rent, the other is in the kitchen with you at midnight trying to figure out why the sink is leaking. And this isn't just my take. Listen to what finance leader Tanya Montmien says. The model flips the traditional VC dynamic from being capital allocators to becoming true co-builders. And that's it, right there. The whole relationship gets turned completely upside down. It's a total mindset shift. All right, so we get it. They're more hands-on, that's clear. But so what? What's the real advantage here? Let's look at the case for studios. Why is this model gaining so much momentum? What's the big payoff that makes all that extra work worth it? Honestly, it really boils down to one big idea: control. You're talking about enhanced control over how things get done, which dramatically reduces that terrifying early-stage risk. You've got a system for validating ideas before you go all in. It creates this natural alignment between the teams and the expertise they need. And maybe most importantly, you have all these shared resources, think marketing, legal, HR, spread across all the companies in the portfolio. The whole goal is to smooth out the chaos of a new startup. It's an attempt to build a startup factory, something that produces results reliably instead of just buying a bunch of lottery tickets and hoping one hits. And you can bet that promise of control is music to investors' ears. And the proof is in the pudding. Just look at this chart. When it comes to funds hitting their target in the first year, a full 50% of studio funds get there. Compare that to standard funds, where it's only about 31%. That is a massive difference. It tells you that the people with the deepest pockets are really buying into this model. But let's be super clear, this is not an easy path. It is a grind. I love this quote from Daniel Riedel, a partner at GenLab Venture Studio. He says, "It's the most fun you'll ever have and the hardest work. Unlike a fund, you need hands-on multi-domain operators." He's basically saying, you can't just be an analyst looking at spreadsheets from 30,000 feet. You need people who can dive right into the trenches and solve problems. Okay, but here's where the story gets a little more complicated. Is all of this really about pure innovation? Or could something else be going on? This brings us to a more critical look at the studio surge. Because there's an argument to be made that this isn't about innovating, it's about finding more predictability. And this really gets to the core of the debate, doesn't it? Is this momentum because people truly believe in the studio model? Or is it more about a fatigue with the old way of doing things? You have to ask yourself, are investors running towards this new model because it's genuinely better? Or are they running away from the chaos of traditional venture? Someone put it really bluntly, and I think it's a fascinating way to look at it. They said, studio models are the closest thing to venture as a product. Think about that for a second. The idea is to take this this messy, chaotic, almost artistic process of creating a company and product, and productize it. Turn it into something you can repeat, something you can scale, something predictable. So if you look at it through that lens, the appeal is crystal clear. The argument is that this shift isn't really about groundbreaking innovation. It's about finding a way to control the absolute chaos of founders and market timing. In a world that's famous for its wild unpredictability, studios are selling a beautiful dream, a clean, repeatable engine. And that right there brings us to the core trade-off in all of this. It's this constant battle between consistency and, well, serendipity. And it's really the central tension in all of venture capital. Because at the end of the day, studios solve for consistency, not serendipity. And here's the billion-dollar question that comes with that. Studios are engineered to be consistent. They're built to hit singles and doubles, to get on base, and to avoid those big, embarrassing strikeouts. But, and this is a huge but, by designing all of the chaos out of the system, do you also lose the chance for that magical, unexpected, game-changing grand slam? So what's next for venture? We've got this fascinating tension, the de-risking machine on one side and the potential serendipity killer on the other. With those two forces in play, what's on the horizon? First things first, let's put things in perspective. Let's go back to that 13% number. Yes, the growth is incredible, it's the big story here, but it's still the minority, by a lot. We have to be careful not to mistake a really fast-growing trend for, total domination of the market. Not yet, at least. So what's a potential future look like? Well, it's probably not going to be some winner-take-all battle. What's more likely is that we'll start to see a hybrid approach. The lines are going to blur. You'll probably see established VC firms start to borrow from the studio playbook, offering way more hands-on support just to stay in the game. And all of this leaves us with one last big question to chew on. Are venture studios the next dominant model? Is this the beginning of a whole new era for venture capital? One that's all about control and predictability? Or is this just a really compelling counter-trend? A powerful reaction that will eventually just settle into its own niche in a much bigger ecosystem? Whichever way it goes, it's going to define how the next wave of world-changing companies get built.